Today we're going to talk about state and local tax deductions. Those are sometimes called the SALT deductions. And this is relevant because they just recently changed this in the tax bill, the one big beautiful bill that just got passed this month. So NAR has put out a new consumer guide on that, and I thought we would go over that today. So let's jump in. Consumer guide, state and local tax deductions. Home ownership has always had its perks when it comes to tax deductions, but the latest tax reform helps homeowners save even more money. Here is why. When filing your federal income tax return, you have a choice. You can use the standard deduction or itemize your deductible expenses. When your deductible expenses exceed the standard deduction, it reduces your taxable income, which means less of your hard earned income goes to Uncle Sam. Most taxpayers today use the standard deduction. For 2025 tax returns, the deduction is $15,750 for single filers, $31,500 for married couples filing jointly, and $23,625 for heads of household. But as a result of the tax reform bill signed into law July 4th, 2025, more current and prospective homeowners are likely to itemize deductible expenses in the coming years to reduce their tax liability. That's because the legislation temporarily quadruples the amount of money you can deduct for state and local income taxes, including property taxes that you have paid. Beginning with the 2025 tax year, you can claim up to $40,000 in SALT deductions, SALT being state and local taxes. Quadruple the $10,000 maximum in effect from 2018 to 2024. The deduction increases slightly each year through 2029 and then reverts to $10,000 unless Congress acts to preserve the increase. There's a phase down for those with modified adjusted gross income over $500,000. The new law also preserves the mortgage interest deductibility at the level set in the Tax Cuts and Jobs Act of 2017. Why is deductibility of mortgage interest and SALT important? The ability to deduct mortgage interest and state and local taxes from your federal return has been a key benefit of homeownership for more than 100 years. The TCJA, the Tax Cut and Jobs Act of 2017, limited the SALT deduction to $10,000 while nearly doubling the standard deduction, driving more taxpayers to use the standard deduction. According to the Tax Policy Institute in 2017, 31% of individual income tax returns included itemized deduction. The number dropped to 9% in 2020. Because they pay property taxes, homeowners, especially those in higher tax states, were disproportionately hurt by the $10,000 limit. That's why the National Association of Realtors vigorously advocated for an increase in SALT deductibility. NAR supports policies that make home ownership more accessible and affordable. Home ownership strengthens communities and correlates positively with social benefits such as educational outcomes, civic engagement, and health. How do I take advantage of the new SALT limit? Deductions are itemized on IRS Form 1040 Schedule A. In addition to SALT, the most common deductible expenses are mortgage interest, contributions to qualified charitable organizations, medical and dental expenses over a certain percentage of your adjusted gross income. The new law also restores deductibility of private mortgage insurance premiums. This insurance is generally required for borrowers who have less than 20% equity in their home. Be sure to maintain good records and receipts, not only to prove your deductions are legitimate, but also to ensure you do not miss any of the deductions that you are entitled to. Every taxpayer's situation is unique. Consult with a qualified tax professional to determine whether you could benefit from the increased SALT deductions. And please visit facts.realtor for more information and resources. So this really had to do primarily with the recent big beautiful bill that just passed, and there were a lot of other things in that bill too that will affect real estate. Most of the ones I saw will affect real estate in a very positive way. So we will see how this all goes. I'm sure we'll be doing more of these. But anyway, that wraps up this consumer guide on the state and local tax deductions. I am David McCoy. I am based in Louisville, Kentucky. My company is Otimo Properties. I'm a licensed real estate broker in Kentucky and Indiana. I've been doing real estate for almost 25 years. And if you have any other questions, you can reach out to me. I'll put a link to this consumer guide in the description, as well as a link to my website. You can also reach out to me to my website and leave me a comment or a question, or you can also leave a comment or question in the comments. In addition to that, if you're trying to find out things about real estate, certain topics, those kinds of things, you might check out my YouTube channel, Otimo Properties, Real Estate Matters. I've done a number of videos on a whole bunch of real estate topics, and it may very well be that you'll find some answers there. I also have I'm increasing the number of videos I also have available in Spanish. So if you know someone who is looking for answers whose primary language is Spanish, they might check that out too. So that is going to be it for today. We'll wrap it up. Have a great day, and thanks for watching the video. Take care. Bye.